the framing is a little bit different. I mean, ultimately, someone there with a fiduciary responsibility to deliver returns to unit holders still has front of mind their objective of actually delivering returns versus competitors versus the market. But ultimately, the framing that's different within corporate bond markets is that the returns, of course, on offer are finite. Okay, you're going to get your coupon along the way, and if you're fortunate, you're going to get your money in the end. Now, the framing and the way the market is priced also allows you the power of inference, or a greater power of inference than would normally be the case within equity markets. So, for example, a coupon within corporate bonds or bond markets, it expresses the risk associated with that company not being able to pay something back. So the price or the return has a lot more information attached to it than an equity price where people on any given day might be willing to pay 10 times earnings or 20 times earnings for whatever reason, based on momentum or whatever else. So, from that perspective, you are framed by the conservatism that's inherent within the asset class, where people obviously don't want to lose the money they invest, and the finite nature of returns as well. But within that, there is scope for relative value. There is scope for relative assessment that is not dissimilar in some way, okay? Because at the end of the day, we're still taking views around certain sectors. We're still taking views around certain names. We're still looking for those names that are going to outperform the other names, basis the fact that the business profile is improving or credit metrics are rising. So, in terms of the framework and context you look at these things through, they're not dissimilar. But for the fact that, again, outcomes tend to be more finite. I think one of the real dangers is being too far-sighted within investment markets. So, you can pick the destination and you can lose a lot of money. There's generally I think a common mistake among retail investors or investors generally is that they allow their bias or their view around where everything ends up, they allow it to heavily impact how they act from day to day. The reality is what moves around the market price on any given day is more a function of the battle of narratives at work. So right now you talked about concern around deflation. That's a narrative. That's exerting force that is driving rates lower. At the same time, there's another story out there, the story of the reflation trade, the threat of modern monetary theory becoming widespread and being utilised, and capacity utilisation all of a sudden popping up above levels we've previously seen. And that theory and that narrative, that is exerting a certain level of force. So that's what's driving the price from day to day. And what happens is that battle, it ebbs and flows. One theme becomes more dominant than the other. Now, I might have a view that over the medium to long term, deflationary drivers are structural, and as a consequence, the reality is that we battle against an environment where technology continues to drive capacity utilisation lower. That might be my view. But, that battle and the narrative and how it twists and turns, that could change 4 or 5 times this year. So really for me, the key focus is on managing your bets appropriately. Okay, so being conservative, risk managing your positions, keeping your bias in check, okay, and positioning within a time frame where you have information, where you can actually execute. Because the reality is, for us to take a view from an investment standpoint on a deflation trade or a deflationary environment which manifests itself in 2026, from a probabilistic standpoint, there are so many things that have to lead into so many other things to get there. It's just nonsensical to be positioning a portfolio of assets from day to day basis that long-term view. That's a big wheel. It turns slowly. It does provide a constant gravitational pull, but in the medium term, there are other things going on that are more dominant. So, from my perspective, what always worries you as a part owner of a fixed income and credit house, rates going to zero and there being no credit premium around anywhere. I think that would scare most credit managers, because that's existential at that stage, right? So yeah, that might make me lie awake at night, but for very different reasons, right? And the other thing you've got to be careful about is how you assign probabilities around your view or another view, because the reality is we're wrong all the time. The skill is minimising your drawdowns when you do inevitably get things wrong, and being able to maximise the utility where you're near enough getting it right, and that generally requires an investor to be able to moderate their views, to be able to position themselves in a disciplined fashion, to account for all probabilities, those perceived, those that have their bias attached to them, and those that are seen by the investment manager themselves as being unlikely. Within credit specifically, which is the area we focus on, what contrarian basically means is how it sounds. You're selling when they're buying, and you're buying when they're selling. You know, feed the ducks when they're quacking is an old fixed income broker term. But look, when Robert Camilleri and I started this business 10 years ago, the reality was that for a realm to exist, it needed to have an edge, it needed to have a philosophy, it needed to have a way of doing things that wasn't par for the course. It had to actually go towards giving people what they wanted, which sounds like it's common sense, sounds like the type of thing every kind of fund manager or investment manager would do. But you know, unfortunately, in many big firms, you know, they have scale to manage, they have business expectations to manage, and things like that, which can often run contrary to actually delivering outcomes to clients. So, look, when we sat down with a blank sheet of paper, where we got to was that we needed to have the ability to operate within shallower pools. We needed to be able to buy a broad range of assets to deliver the returns that the market wanted. But we also needed to be very active. And when we looked at what being very, very active meant, it became clear very, very quickly that, you know, credit markets have certain characteristics. One is that, especially in the post-GFC period, they've become very, very pro-cyclical from a liquidity standpoint as well. So what that means is that credit desks, banks, very happy to facilitate the buying and selling of bonds in good markets, but when things turn, things tighten up really, really quickly. So what that points to is it points to you being rewarded for being able to ration your capital and ration your liquidity at appropriate times so you can take advantage of those dynamics. Now, being able to take advantage of those dynamics actually forces you, in certain instances, to be able to take money off the table when things are running hot, because of course there's no way we can pick the bottom. But when we can start to see that markets are implying levels of compensation that haven't historically compensated for the kind of risk you're taking. You know, and an example would be, I think there's been a lot of talk around the US high yield market right now paying yields below, or credit spreads below 4%, when in truth, you know, 4%, the default rate for sub-investment grade companies in the United States is 4%. So essentially you're being paid less than the historic default probability. So that gives you a sense that the gravitational pull in that market, for example, is technical, is driven by these supply-demand dynamics, which is driven by a mania of sorts. But for a contrarian investor, when you start seeing something like that, I mean, you're just looking at the numbers. The simple facts are that at that stage you are being paid less than that kind of asset should be compensating you for the risk you are taking. Now, just because it's a little bit expensive right now doesn't mean that it can't get a lot of bit expensive 6 months from now and 12 months from now. So the reality is that for a manager like us in the current environment, the mindset turns from how do we take advantage of what occurred in March and April and May to, okay, how far does this run? How strong is this technical, and when do we start to step off so we are in a position to have capital there so the next time the market sells off, we can lean in, okay? Because that's really been our skill over 10 years. That's what we've been able to demonstrate again and again, is the ability to take the pain, to take reinvestment risk, to take the hits from sitting out and then having the liquidity available when we need to lean back in. Really, you know, contrarian means contrarian in its pure sense. It means genuinely looking to start to move in the opposite direction of the traffic. But, you know, again, qualifying it and making it practical. Being a contrarian for contrarian's sake, there's, you know, there's no honour. There's no honour in that either, right? You know, there's no honour in failure within markets and within funds management. So the reality is that timing is important in all of these things. So, you know, again, I spoke earlier about the gravitational pull exerted by different forces. You know, we're in a market right now where the technical or the supply dynamics, the supply-demand dynamics are arguably different than they've been at any point in the post-GFC period. Here in Australia in particular, where you have a term funding facility that is lending banks money at 0.1, so they don't need to come to the market and borrow money. Banks have a lot of extra money, so they can bank a lot of the companies which will generally issue corporate bonds. And at the same time, Australian households have record amount of money thrown at them from the government, where, you know, savings rates are going through the roof. So, you know, from early 2019, the major banks here have got $180 billion in deposits through their coffers, and they've lent out, I don't know, maybe they've lent out $20 billion. So there's $160 billion sloshing around out there. And then you add a term funding facility, which has thrown another $80 billion on top of that as well. So that's a lot of liquidity. A question for us at the moment is, how does being a contrarian look like when you're facing that kind of wall of money? Because, and this is where you have to be pragmatic as well. Ultimately, we have tended to act in a contrarian fashion. We believe that in general terms, being a contrarian rewards you within fixed income and credit markets. So the one market that probably hasn't pulled right in versus where it was pre-COVID is the RMBS market. So the residential mortgage-backed securities market here in Australia is more or less pricing in line with its pre-COVID levels. So look, on a relative basis, would you say it's rip-roaringly cheap given its entire history on a relative basis versus itself over 5 years? No, it looks like it's trading around in line, but in the context of the rest of the market, it does look quite attractive. The ability to buy BBB RMBS at 3.5 to 3.6% for, these are mortgages that are conforming prime mortgages issued by a non-bank. 3.6% over bills sounds okay in the context of investors happily taking 1.25% over bills to buy bank subordinated debt, which has an equivalent credit rating. So the attractiveness of structured credit versus corporate credit starts to look attractive, and that's another tether. That's another thing that's just next train station out, so to speak, because it's an asset class that is a little bit esoteric, it is more specialised. It's an asset class that has motivated popular culture to the point where you've seen 2 or 3 movies written about it. The acronym still put a shiver down people's spines. So all of these factors create a differential, which we think is very attractive right now, because the ability to maintain that bias in the face of you not being able to fund your cost of living as a retiree, you're going to find in that fight, you're going to let go of your bias first. And it was an anecdote one of our financial advisors gave me the other day where he said to me, you'd realise to match the age pension using the current 1-year TD rate, you need something like $11.5 million to basically generate an income which would equate to a pensionate couple, which is $30,000. So that starts to give you a sense of the fact that income's hard to come by, and you just can't sit on the sidelines. So people will find a way to deal with it, deal with their bias to certain assets. The other market that looks attractive to us right now are private assets. So that's an area where we've developed a real skill and have become market leaders of sorts over the period of the last 2 to 3 years. And there are a lot of opportunities and possibilities that revolve around the wholesale banking market, which essentially revolves around partnering with major banks and financiers for the purpose of assisting them with providing finance, both for home loans and in other products as well. So that's an area where we've been putting a bit of effort into, because essentially I think for our part, we recognised early that if we are in an environment where the centrifugal forces are going to be deflationary and credit spreads get tighter and tighter, delivering outcomes to real Australians is going to become more difficult. So, what do you do at that stage? How do you go about delivering returns, and what's going to be your approach? And as a firm, where do we want to be positioned? So that's where we've really focused on those structured credit markets as being an area of opportunity over the medium term. That's where we're at right now. Answering that question is where we've all gotten to, because yes, you can, but at what cost and with what risk? And a lot of what's in place right now, whether we're talking about central bank assistance in the US, the Fed Reserve targeting rates and buying credit, or we're talking about the term funding facility here in Australia, what we're all aware of is the fact that 2 to 3 years from now, there's potentially a cliff effect as well. There isn't a statement that this support and this liquidity that's being funneled towards banking markets and credit markets is a constant from now on forever. So just to complicate that question a little bit further, you have to be aware of the fact that you've also got the risk out there 1.5 to 2 years from now where the music stops, or the music forces people to actually be in a position where they're going to need that liquidity again. So when you frame it from that perspective, the question you have as an investor is it worth soaking up all of your liquidity right now for the purpose of lengthening and making up that difference? Is it worth being corralled into taking more risk to being able to meet your lifestyle goals, or is the right thing to do to take a more measured approach in terms of how you manage that? So in terms of what that means for us, it means that we want to pick our fights. We're a lot more relative value conscious than we would be normally. We feel that we don't necessarily want bulk credit risk. So explaining what that means is we don't necessarily want to own the index because it's not clear to us that the broad credit indices are going to tighten a lot from here. However, there are a number of relative value trades that could deliver, a reasonable return over the next 12 months that allow us to meet our target. So for us, what it means is pick our fight, but not to the point where we overextend. So we still feel like we want to hold on to a little bit of liquidity here, and if this market continues to run, we'd essentially be more inclined to take more off the table as it lengthens and reposition the portfolio in such a way where we start to expose our clients to a lower risk of capital loss or capital underperformance. So we're almost at the point now where the two discussions are evenly weighted. We're not sitting there right now feeling like, jeepers, what do we need to do to get more yield? Because frankly, that's classic late cycle behaviour, isn't it? So you're more so wanting to sit back in a pocket right now and really be careful about what you do. Bigger, more difficult question is what it means to the end clients. And I think for us, it's always really important to understand that we're here to serve. Sometimes you can get really stuck in the relativities when you're managing funds. You've got a close eye on your competitors. You're looking at your numbers versus the next guy. But the reality is, at the end of the chain, are real people that are trying to live their lives and pay for their cost of living and take the grandkids to the zoo and stuff like that. That is why we exist. So what do they do? That's an interesting question as well. I think the idea that you could run the good old-fashioned Aussie barbell, where you run a bucket load of cash at a reasonable TD rate and you punt the equity market with the other half. It feels like that's really changing. It feels like that's over. So and that might not be a bad thing. So I think what that sort of points to is the fact that people are needing to think a lot more about how they manage their asset allocation, how they ration their capital, and I think what it does, it really puts the onus on the fact that having lazy money there, or a very large amount of lazy money, on the logic that you'll be able to crunch it out of the park in equities or growth asset classes, I think that's gone now.